Hey everyone, this is Ronak Ahuja. Welcome you all again. In our earlier videos, there was one common topic that found consistent mentions in all the other topics that we had been discussing. And that special topic was the provisions relating to the tax audit report as per the Income Tax Act. Now, I'm pretty sure there would be one question on everybody's top of mind, and that is what exactly tax audit is and who is it applicable to? Now, in this video, we'll be touching every aspect of the tax audit, including its applicability, objective, the consequences, as well as the penalties for not filing the tax audit report. So, you can be rest assured that by the end of this video, you will understand every aspect of the tax audit provisions of the Income Tax Act. So, without any further delay, let's quickly begin. Before discussing the applicability of tax audit, let's first try and understand the need for audits under the income tax provisions. Let's discuss this with an example. Say, for all the incomes that have been earned during the financial year 24-25, the returns for the same will be filed during the financial year 25-26. The taxpayers would determine incomes from all the sources that have been earned during the financial year 24-25 and calculate taxes on the total income. Once the taxes are calculated, they'll file their income tax returns within the due dates. This means the entire process from calculation of total income till the filing of returns is a self-assessment process. That is, the taxpayer himself determines the taxes on the total income and submits the return accordingly. The government then accepts these returns that have been self-assessed by the taxpayers. The refunds are made according to the self-assessed returns that have been submitted to the Income Tax Department. Now, one thing to note is the Income Tax Department relies on the information that has been provided by the taxpayer on the basis of self-assessment. Now, as we are aware, whenever the taxpayer pays taxes on the basis of self-assessment, there are high chances of errors that might be intentional or unintentional. Or even though the government is aware of this fact, it still accepts the ITS that have been submitted by the taxpayers, as long as the profits do not fall below the specified limits. Now, what does this mean? In case the profits fall below the specified limits that have been set by the government, then in such a case, the government will still be accepting the return, but with one additional requirement. The government would require you to get your books of accounts audited by a chartered accountant and then obtain an audit report from the chartered accountant and submit it to the department along with the ITR. Now, this audit report is submitted before you file the income tax return. This type of audit is called a tax audit. So, with this, we understand that the first reason for audits under the income taxes is when we report lower business profits below the expected limits of the income tax department. The second reason is when the volumes of the businesses shoot up, the likelihood of occurrence of errors also broadens. Now, what does this mean? Whenever the volumes of the business increases, the chances of occurrences of errors also increases with the increasing volume. This means if the gross turnover of the business exceeds a certain benchmark limit that have been set by the government, then in such a case, to ensure the correctness of the claims of the businesses, they will have to get their business accounts audited by a chartered accountant. Once these accounts are audited, a report will have to be submitted by the tax auditor to the Income Tax Department. And this again has to be done before the ITR is filed by such business. So, we understand that these are the two big reasons why we needed to have audits under the income tax provisions. Now moving on to the applicability. Now let's discuss the applicability of tax audit. That is, when is this tax audit actually applicable? We just discussed in our previous discussion that the tax audit would be applicable in case of two broader scenarios. Now let's first discuss the first broader scenario, that is when the gross turnover or the volume of the business exceeds the specified benchmark set by the government, where the turnover of the business during the financial year exceeds rupees 1 crore, then in such a case, such business will have to get its tax audit done. Now there are three exceptions to it. The first exception is where in case the turnover of the business during the financial year is up to rupees 2 crores and such business is eligible to opt for 44AD and it further reports profits as per section 44AD subsection 1, then in such a case the tax audit won't be applicable. This means if the turnover of the business is up to rupees 2 crores during the financial year and it reports profits as per section 44AD subsection 1, that is, it reports profits greater than 8% or 6%, then in such a case, tax audit won't be applicable. Now, moving on to the second exception, where in case the turnover of the business is up to rupees 3 crores during the financial year and it's a business that is eligible to opt for 44AD and it reports profits as per section 44AD subsection 1, then in such a case, the tax audit will not be applicable again, provided it satisfies one more condition. And that condition is that the total sales collection in cash should not exceed 5% of the total collection of sales during the financial year 24-25. So this is one additional condition that is to be satisfied in case the turnover is up to rupees 3 crores. Now moving on to the third exception, where in case the turnover is up to rupees 10 crores, then in such a case the business will still not be required to get the tax audit done in case it satisfies both the following conditions, where the turnover of the assessee or the business exceeds rupees 1 crore but is up to rupees 10 crores during the financial year, then in such a case the tax audit will again not be applicable, provided both the following conditions are satisfied. The first condition is that the sales collection in cash for the financial year 24-25 must not exceed 5% of the total sales collection. The second condition being the payment of expenditure in cash should not exceed 5% of such total payment during the financial year 24-25. When both these conditions are satisfied and the turnover is up to rupees 10 crores, then in such a case, tax audit will not be applicable. So, in a nutshell, we can say if the turnover exceeds rupees 10 crores, then the tax audit would be applicable. In case the turnover is up to rupees 2 crores and section 44AD subsection 1 is applicable, then in such a case, tax audit will not be applicable. Now, if the turnover is up to rupees 3 crores and the SSC is covered under section 44AD, then in such a case, tax audit will again not be applicable. In case the turnover is up to rupees 10 crores and it satisfies both the two conditions that we just discussed, then in such a case, tax audit again won't be applicable. Again, if the turnover is up to rupees 10 crores, but it fails to satisfy either of the two conditions that we just discussed, then in such a case, tax audit would become applicable. Now, let's move to tax audit for professionals, where in case the gross receipts for professionals exceeds rupees 50 lakhs during the financial year, then in such a case, such a professional would require to get its tax audit done. Now again, there is one exception to it, where in case the gross receipts of such profession exceeds rupees 50 lakhs but is up to rupees 75 lakhs during the financial year and it reports profits as per section 44 ADA, then in such a case the tax audit again won't be applicable, provided one more condition is satisfied. The other condition is that the receipts of such profession in cash should not exceed 5% of the total collection in case of such profession during the financial year 24-25. This means in case the gross receipts is up to rupees 75 lakhs and such profession reports taxable profits not less than 50% of the total receipts and satisfies this condition of 5% of receipts in cash, then in such a case the tax audit will not be applicable. Now moving on to the second broader category, that is when the taxable profits fall below the expected limits of the government, where the assessee carries on any business that is covered by section 44 AE, 44 BB and 44 BBB and such assessee shows profits lower than the limits specified in these sections, then in such a case the tax audit would become applicable. This means any assessee that carries on any business that are referred to in these sections will have to show profits greater than the limits provided under these sections, else the tax audit would become applicable. Now, where in case an assessee is covered under section 44 ADA and shows profits lower than 50% of the total gross receipts of such profession and the total income exceeds the basic exemption limit, then in such a case the tax audit would become applicable. Any person who is covered by section 44 ADA, he'll have to show profits greater than 50% of its gross receipts to avoid tax audit. In case he fails to do so, the tax audit would become automatically applicable and he will have to get the tax audit done. Moving on to the third case, where in case an assessee becomes ineligible as per section 44 AD subsection 4 to opt for the presumptive taxation scheme, then in such a case he would again be required to get the tax audit done. This means where an assessee has become ineligible to opt for the presumptive taxation scheme because of opting out of the presumptive taxation scheme in the preceding 5 financial years, then in such a case the tax audit would become applicable. So this was the applicability of tax audit, that is, to these persons the tax audit would be applicable and they would be required to furnish a report from a chartered accountant. Now, what happens if you do not file the tax audit report on time? Certainly, there are some penal consequences attached to it. In case you fail to file the tax audit report or fail to get the tax audit done, then in such a case, the penalty payable would be 0.5% of the gross turnover or the gross receipts of such business during that financial year. However, the penalty won't exceed rupees 1,50,000. Furthermore, there's an exemption also. In case there's a reasonable cause for not filing the tax audit report, then this penalty shall be waived off. So far, as per the judgments of the tribunals or courts, the following causes have been considered to be the reasonable cause. First, any occurrence of a natural calamity. Secondly, loss of accounts due to any reason which is beyond the control of the assessee. And the third one, any physical inability or death of the partner who is in charge of accounts. So these were some of the reasons out of many other reasons that have been admitted by the courts or tribunals to waive off the penalties. Having said that, we would always insist all our viewers to file their tax audit reports or any other forms or income tax returns always on time. So now let's discuss what are the forms that are required to be submitted in case of tax audit. Where in case the assessee or the taxpayer has been audited under any other law other than the Income Tax Act, then in such a case he will have to file Form 3CA and Form 3CD. In case there have been no audits conducted under any other law, then in such a case the assessee will have to file Form 3CB and Form 3CD. These forms will have to be filed before the income tax return is filed. The due dates for filing of the ITR as well as these forms have been discussed in a separate video. The link to those videos have been mentioned in the comment section. Do remember to have a look at those as well. So, with this quick short video, we hope we were able to clarify all your confusion surrounding the tax audit provisions of the Income Tax Act. In case you couldn't follow, please drop us a feedback in the comment section or mail us at talklaviz@gmail.com. Thank you and stay tuned.